Okay, account based COPA, which means here, if you think broadly about these things, three areas we are going to divide it. One is the standard costing, second one is the actual costing, third one is the marginal costing. But how we are going to implement in SAP means here, product standard costing we are going to implement by way of a product costing. Product costing means a lot of scenarios are available, like product costing by order, by period, by sale order. And material ledger, how we are going to implement means, what is the purpose of the material ledger tool in SAP means for calculating of a actual costing. Here itself also a lot of scenarios are available. How we are going to implement this multiple currencies if companies are following a more than one currency, and companies are following if it is in transactions, cross company code transactions. How we are going to implement of actual costing with this type of a business process means it's nothing but a transfer pricing. If it is a company code to company code transfer pricing, and within the plant, within the company code, intra company, inter company, through all the scenarios are available in material ledger techniques. And COPA means margin analysis. Here right now all companies are wanted to go implement by margin analysis, because of this is a very useful for reconcile purpose of FI as well as on CO. Account based COPA also we can able to reconcile, but some of times means each GL account, if you make it as a some account COPA one value field, then okay, you can do it. But here lot of functionalities are available in marginal costing nowadays. Here that too, version to versions they are going to increasing. Earlier 2020, 1909, some versions are not available in free apps. But here that all apps are available here in marginal costing, that also they are going to increasing from version to version. So because of this standard costing, actual costing, marginal costing, to do this type of a concept, how we are going to implement in SAP? What are the techniques, what are the tools and techniques are available in SAP S4HANA? For that, what are the need to be done? Suppose, for example, for product costing, we need to implement FI, CO, SD, PP module. But to get the actual costing means and how accounting entries purpose, FIMM integration for all point of view. And reporting point of view completely, how what are the characteristics are need to be done. So for these techniques, for this type of a SAP product costing, material ledger, margin analysis tools, which are available in S4HANA, to do implement these techniques, what are the necessary settings are need to be done in SAP? Broadly, if you go and check in SAP S4HANA, we are going to divide into these three areas only. One is the standard costing, second one is the actual costing, third one is the marginal costing. These are domain concept. But coming to the SAP, this like this we are going to implement. Whether if you follow up with this SAP ECC R3 S4HANA, whatever it may be, the tools are available, but S4HANA some additional features are available comparable to ECC. This is the normal domain functionality. This one here. Okay, we decided we are going to complete implementing of a standard costing, actual costing, and marginal costing by way of a techniques of available in S4HANA. Product costing, what are the all scenarios, and material ledger all scenarios, and account based COPA, some what are the additional features are available to do manipulations of data after completion of a all business transactions like sale order, delivery, billing, like that. Okay, before going to discuss about these things, first we need to understand what is the first stage, because of we are in implementation stage. Today is the first day of we are going to meet the customer, means we are going to meet the client. First, how we are going to interact with the customer? how we can get the data from the customer. Because of they don't know SAP, we don't know their business process. But how we are going to interact with the customer, how they are giving, because first of all, we don't know. They are normally business people, they will not believe. So how we are going to interact, how we get that business, how we get the as you study current business process, that we need to understand first. It means here, one is the current status of business process and how we are going to implement future state of business process. Current status business process is nothing but a as is study, but here we will not call as is study in S4HANA. That future business state of business process is nothing but a, in SAP, how we are going to implement of this concept in SAP. That is nothing but a FSBP, future status of a business process. Okay, first to these two, because of if current state of business process means existing business process is available in the customer side, but they will not give us directly. If you go and ask, give me your organization structure, give me your what is your business process, means they will not believe. First, we need to interact with this one. First of all, how we are going to discuss about the organization structure. First step is because of based on my experience, I am going to divide broadly 5 areas. How we are going to discuss about the as is study, how we are going to implement to be study. Then first one is the organization structure. Organization structure, what is the existing organization structure? How many company codes? How many plants? Like that, how many sales organizations? How many distribution channel? How many divisions? Is there any cross to plant? Means like that of all information we need to discuss with the client. Once they gave the information, then we are going to implement in our SAP enterprise structure, like creating as well as assigning, along with some chart of accounts of your account. What is the GL account? What is the length of this? Whatever it may be. Here, organization structure based on their information, we are going to implement. That means here, before going to start off business process into this SAP system, first we need to clear cut picture of to know the organization structure. Because organization structure is the main first important point. Later, if they come and no, this plant is not assigned to this company code or some other company code, to avoid this type of a discrepancy from customer side, first we need to clear about the organization structure. We need to prepare one business process design document separately for organization structure, need to get the sign off. After that only we need to prepare some other settings. So first we need to clear picture of the organization structure based on the discussion with the customer, existing environment, then how after that we are going to decide by way of implementing in S4HANA SAP. Okay, this organization structure is finalized, means how many company codes, how many plants, how many sales organization, how many distribution, how many divisions are there. Then next to go for business process. Business process means what type of a business process they are going to do. Is it manufacturing or trading or some other anything? Majorly, we are discussing about the manufacturing as a trading. What type of actually business process they are going to do existing environment. That means for example, suppose manufacturing. Again, we need to ask one more question. Is it MTO scenario or MTS scenario? If it is a manufacturing side, what is the type of a manufacturing process? Make to order or make to stock? Even trading also, make to order we are going to implement. Even it's not a manufacturing process. So first we need to clarity about the business process of existing business process. MTS, make to order scenario or make to stock scenario. Then how we are going to this after finalizing of a make to stock or make to order of existing business process, how we are going to implement in our SAP point of view by way of a product costing techniques. Just product costing techniques is useful for all scenarios of MTO as well as MTS. Okay, here manufacturing MTO, MTS is finalized. Then what type of a manufacturing process of MTO as well as MTS? Again, question, after manufacturing of business process identified, what type of a manufacturing process means here, whether it is a discrete manufacturing or a repetitive manufacturing. MTS, MTO means, okay, we finalized product costing is going to need to be implemented for this existing business process. And again, manufacturing process means is a discrete manufacturing or repetitive manufacturing. If it is a discrete manufacturing, what type of a product costing techniques are available by product costing by order as well as a sales order? If it is a repetitive manufacturing, what type of a product costing techniques we are going to use means product costing by period scenario. Means a discrete manufacturing by order by sale order, and repetitive manufacturing by period scenarios are going to fit for this business process. Nature of the business process, nature of the manufacturing process, we are going to implement these product costing techniques. Product costing by order, by sales order, as well as a by period. Suppose, for example, both discrete as well as a repetitive and MTS and MTO, all scenarios are applicable for this current business process. Then we need to implement for all scenarios. By order, by period, and by sale order. Okay, then after that, how we are going to do testing for each cases. Suppose one material having a one plant, transferring one plant to another plant is nothing but a one plant having a manufacturing plant, second plant having a depot plant. How we are going to transfer, how we are going to costing transfer from one plant to another plant, how we are going to do quantity if there is any accounting entry backend. Accounting document, is there any accounting document updated or not? Suppose subcontracting process. If material is a manufacturing outside, partial manufacturing, then that is a outside manufacturing is only we are going to supply the material. In this case, how our product costing is going to apply to our manufacturing process, our business process. Suppose partial manufacturing in our business in our company and partial manufacturing outside, how we are going to test with external business process. All business process, whatever the applicable, each and every we are going to test it. Each and every business process we need to go just like a proof of concept, POC. Then finally, most important point is the reporting. Okay, we prepare the organization structure, finalized business process, and also manufacturing process finalized, and testing each and every business process which are available in our current organization structure. Then how we are going to represent, how we are going to reporting. Present reporting point of view, there may be some Excel sheet or some other any ERP tool. But how we are going to represent in our SAP point of view, either SAP Fury apps or any other report. Each and every have a one report is there. Maximally, that reporting means in FI side, we are going to prepare financial statement, balance sheet, as well as a profit and loss account. Ultimate is a profit and loss account as well as a balance sheet. And the second thing is his costing point of view. Majorly, I'm going to use of this one material price analysis by way of a material ledger implementation, by actual costing implementation. So first of all, we need to understand of this CSBP as you study current status, as well as how this current status, how we are going to map into the business transformation. Earlier scenarios means earlier ECC and R3 they are going to implement just implementation of SAP, but nowadays completely digital financial transformation. We can call it as a simply digital financial transformation, means lot of tools and techniques adding in marginal costing by way of implement of FDAPs. Then we are this now. This we can call as a digital transformation from existing scenarios to SAP scenario. And as SAP also, frequently they are adding a new functionalities from version to version. 2020, some features are not available. 2021 only available. 1909, some for example, predictive accounting in for margin analysis. Before 1809, there is no predictive concept. 1809 onwards predictive that too 1809 and 1909 have some difference. 2020 and 2021 we can able to view report in FDAPs, that predictive concept. Earlier we have seen only for AC Doka table only. Like that, in each technique, each feature of margin analysis point of view, the version to version they are going to implement. Till now, one more thing is the attributed profitability analysis. New concept is available in margin analysis. Till now, in 2021, there is no concept of a FDAPs. Again, we need to go and check in AC Doka table only. Like that, they are also keep on increasing their levels from version to version by way of activating of a FDAPs. Okay, then here product costing, as well as what are the product costing and material ledger techniques, what are the margin analysis, what I am going to explain this in these sessions. Product costing techniques, as we discussed, based on the existing business process and manufacturing process, we are going to implement product costing techniques by way of a product cost by order. First scenario, if we are following of a discrete manufacturing with the PP module. With the PP module means PP production planning module implemented, how we are going to deal with integration with the PP module. In some cases there is no PP module, production planning module. How we are going to deal with the product costing? They wanted the product costing, they wanted to actual costing, they wanted to go for marginal costing also, but there is no concept of a PP module. So this is the with the PP module. Second one is the without PP module. Without PP module. This one. And second thing is if companies are following up, suppose these two are manufacturing process is a discrete manufacturing, and this is suppose if it is a manufacturing process, repetitive manufacturing process, how we are going to implement means product cost by period scenario. Period scenario means here there is no concept of a manufacturing order wise process, there's a material wise process. Period oriented wise manufacturing process we are going to follow if the companies are following a repetitive manufacturing process. Repetitive manufacturing process means input to materials they are not going to change, and the manufacturing process they are not going to change irrespective of a competitor product, irrespective of a market strategies. They are fixed, whatever it may be in market, whatever it may be customer oriented. But coming to the discrete manufacturing means Based on the market strategy, based on the customer specification, our manufacturing process keep on changing. That is the main difference between discrete as well as a repetitive manufacturing. But both the cases is a concept is a different, but accounting treatment, accounting entries should be same for all irrespective of product costing implemented. Whatever product costing you are going to implement, our accounting entry should not be changed. Same accounting entry, debit same accounting, credit same accounting. But our product costing implementation treatment is a different from one business process to another business process. Here also some three scenarios are available. Product costing by period scenarios, like reporting points implement, but without reporting, with reporting under some mixing of product costing by order as well as a by period scenario. Total three scenarios are available. And fourth one, suppose completely this manufacturing process we are going to deals with make to order scenario. If make to order scenarios, how we are going to implement this one means product costing by sales order. Means here first these two scenarios means by order by period scenarios, starting with manufacturing process by way of a manufacturing order, either by way of product costing by PP production order or by CO production order, whatever it may be. But here in this case of based on the make to order scenario, means first we need to generate a sale order, because of here already customer identified in this scenario. In these two cases, customer not identified. So here completely the sale order concept is a completely different from other scenarios. So we should not do any standard predefined rate by way of a standard costing. We should go for by sale order costing. That means here customer identified and manufacturing process starting with respect to sales order and production concept with respect to sales order and goods movement with respect to sales order. Means everything here link up with the sales order. Means each sales order wise how much of my expenses, how much of my revenue, how much of my income generated, profit generated. For that purpose, we are going to implement this product cost by order sales order scenario. Here also three scenarios are available. One is the valuated, second one is the non-valuated. Valuated means again two scenarios are available. One is the valuated, second one is the non-valuated. Valuated means how accounting entries is going to flow at the time of a goods receipt as well as a goods issue. Goods receipt means after manufacturing, material from shop floor to inventory, is there any accounting treatment exist or not? If it is non-valuated means there is no accounting treatment. If it is a valuated means accounting treatment will generate. Non-valuated means there is no accounting and treatment for goods received with respect to sale order from shop floor to means shop floor means in which manufacturing is going on. From there to our inventory means is nothing but a storage location. At the time of a delivery with respect to the sale order, is there any accounting treatment or exist or not? So that is if there is accounting entry exists, that is going to deal with valuated. If there is no accounting treatment at the time of a goods movement of particular sale order, that is nothing but a non-valuated. I will show you in the system directly, but what I'm going to explain in the system that I'm going to briefly about these scenarios. And here, suppose this is a by order, by period, by sale order scenario. Some extra concept are available. Suppose for one material, raw material, we are procuring from different locations or different vendors. One material, raw material purchasing vendor 1 and vendor 2. And vendor 2. How we are going to deals with means 70% of the materials we are going to purchase from this vendor. Suppose this material is a raw material, and remaining 30% of materials we are procuring from this vendor. But for this vendor, if it is this vendor purchase order, and for this vendor purchase order having a may difference price. If this type of a this type of a different purchase price from different vendors, how we are going to handle this material? Suppose this material is a our raw material to our manufacturing material. So this, if it is input material having a two different prices, how we are going to deal with this manufacturing process by way of a product costing by order scenario, or by sale order, or by period scenario. This is nothing but a mixed costing process. Raw material means mixed costing means having this raw material is a purely purchase material. So we are going to link with purchase order vendor point of view. Suppose FG material, if it's a raw material is a FG, if material is the FG material, manufacturing matter. Sometimes we can do manufacturing, and sometimes we can do purchase. Some make or buy decision point of view. If the material is a procured from outside, how much of expenses we need to be incurred, we need to be bear. If it is a manufacturing same material, how we need to be. So after manufacturing, after estimation of a manufacturing, after purchasing of a material, we will get some clarity whether this material will go for manufacturing or as well as purchase. So if the material is the same material having a purchase as well as a manufacturing, how we are going to deal with this concept? This is the one technique, is the mixed costing process. And second, finally, for FG material, this is the most important concept. This FG material is a purely manufacturing material, having a multiple lines of manufacturing process. For example, plant 1, plant 2, plant 3. Plant 1 is the new plant having a new machinery. Plant 2 having a some old machinery. So old machinery means old manufacturing time consuming is heavy, and a lot of utilities also need to be more than coming than new material, new plant manufacturing process. So here, comparable to new machineries requirement manufacturing process, old machineries are requirement of input materials are requirement of more, as well as a manufacturing process. But we need to be manufacturing because of this material having that plant and machinery having a life, still asset life is a some time is there, some 3 years, 4 years. We don't want to throw directly there. We will use. So if this is a mixed manufacturing process, partially manufacturing of 80% of new plant and 20% as of old plant, if you are clubbing of these two, which type of a cost we will get arise? How we are going to evaluate if type of a business processes companies are following? These are all are comes under the mixed costing process. Mixed costing process means if material, raw material procurement from different places, and the same SFG material, if you are both manufacturing as well as the purchases, and coming to the FG material, if you are procuring, means if you are manufacturing multiple lines, all we are going to deals with in the mixed costing techniques of in our product costing. You can use by both by order scenario, by period, as well as by sale order. And the sixth point is the, suppose here manufacturing process, partial manufacturing, fully manufacturing outside. First, fully manufacturing outside we can do. Fully manufacturing outside means here we will send raw materials to vendor. Instead of a manufacturing in our plant, we need to help from outside, means we need to help to do manufacturing of our requirement of material from vendor side. Because we don't have any manufacturing process in our area because we don't have time, some other reasons. This how we are going to deal with this type of a costing process. We will send raw material instead of a manufacturing cost, how we are going to bring into our product cost. This is nothing but a subcontracting process concept of a, if is a manufacturing is a fully outside. Then whereas partial manufacturing, some manufacturing we can do in our location, in our plant location, and some other manufacturing process we can take help from outside outside vendor. These two expenses how we are going to bring in our product costing. Both are subcontracting process, but here this subcontracting process is nothing but a fully manufacturing. Second one is the partially manufacturing. Two scenarios are available subcontracting process. One is of manufacturing fully, we will not touch of any manufacturing process, and we will take help some portion of manufacturing process like cleaning, packing, some other. Only those activities we are going to take help from outside vendor. This is how we are going to link in our technique, costing technique. One more point. Suppose one material, manufacturing material, one plant A. But we are going to send plant 2 material. From there to we are going to send to customer. Plant 1 means the same material. From plant 2 we are going to send a customer. Because of this customer very close to this plant. This plant is far away from this customer. In this case, plant 1 having a material manufacturing process. Plant 2 only depot plant. There is no manufacturing process in plant 2. So how we are going to transfer material transfer, okay, stock transfer from one plant to another plant, that is okay. But how we are going to transfer cost from one plant to another plant? Because of here in this plant having a manufacturing cost, we can analyze how much of a predetermined cost, material cost, manufacturing cost, any overhead cost like that. But this we need to transfer from this plant to this, from there to we are going to send it to customer. Plant 1 is a manufacturing, plant 2 is the depot plant. But cost should be same for both the plants because of this material within our company code only, not from outside. Pure manufacturing, but here transferring from one plant to another plant. This is nothing but a special procurement key process. If we are implementing of a special procurement key, how this is going to link with our product costing material ledger as well as. Here don't bifurcate material ledger separate, product costing separate, COPA separate. All are linked only. Because once we technique of implement, what is the result of in terms of a standard costing? What is the result of in terms of actual costing? How we are going to report in COPA? We have to see simultaneously for all. Don't to cut pieces like that. Product costing separate, actual costing separate, COPA separate, not like that. Then suppose one in business process having a multiple manufacturing products simultaneously. Suppose, for example, our main manufacturing material is a A. Along with the manufacturing material A, B also will come. After manufacturing output. Means here, if you identified B material is a wantedly manufacturing, then this is nothing but a co-product. If B material is not identified, we don't know how much of a quantity will come, how much of how much of a quantity will come, when it will come. Because of it is manufacturing process is a multiple lines, we will not expect when it will come and how much of quantity will not come. If not identified, that material we can call as a byproduct. Means here joint production. Joint production means not only material manufacturing A, B also will come. If B, if you wanted to, means wantedly, if you are going to manufacturing, then these two products is called as a co-products, is nothing but a joint production. If a B material, we don't know when it will come, when it will come and how much of a quantity, not identify, not intentionally manufacturing of second material, that manufacturing process is the byproduct costing. Co-product costing as well as a byproduct costing means second joint production process it will come. Joint production means both A and B will come, but depends upon the second material manufacturing status. We will go and decide whether it is a co-product or byproduct. If it is a intentionally manufacturing of a second product, then that manufacturing process is the co-product concept. If it is not intentionally manufacturing of a second product, then that costing process is nothing but a byproduct cost. This one. And here, major is the scrap. Here, sometimes byproduct which is a saleable in the market, then we can, or this material we are going to use as a component for some other manufacturing process, then okay. If it is a completely is a wastage material, if it is a wastage material, then we can call as a scrap. This byproduct, not co-product. Only byproduct, either byproduct or scrap means if it is a manufacturing by this material, if it is a reusable or saleable, okay, you can go and treat as just byproduct. But which is not a useful as a input material as well as a saleable material, then we can call this material as a scrap. But this scrap here we can visible, if we are able to visible that second material, then we should call it as a byproduct. But one more concept is a scrap costing. Scrap costing means if manufacturing process, only here manufacturing process, nothing but a assemble and operational. This material is only dealing with the second material scrap. This scrap costing is nothing but a output to manufacturing process. Assemble scrapping, operational scrapping, and combined scrapping. Combined scrapping is nothing but a assemble scrapping. This is the dealing with only for FG material. If companies are following a scrap costing, scrap implementing in the material master or any other statement, how we are going to deal with product costing? This one. So here, majorly of these type of a product costing techniques, but still some other techniques also will come. But majorly for all industry sectors, either of them they are going to. But I am not saying all scenarios they are going to implement in one scenario, but it depends upon the product, depends upon the scenarios. For example, I implemented to steel industries manufacturing process. In India, only product costing by order scenario only they implemented. In some other and outside other countries, product costing by order with sale order scenario they implemented. Manufacturing process same, but business process is the same, but client to client completely techniques is the different. Same product costing different, material ledger different. Here they are following a multiple currencies. They wanted to go for only company code currency, group currency. They are here, they wanted to complete a transfer price. So steel industries means only business process we can able to identify. Coming to the SAP, from one customer to another customer, completely different technique they wanted. This is the product costing techniques. Still lot of techniques are there while discussing, like some rework order. Lot of scenarios are available in product costing. We can discuss how one by one this thing. And coming to the material ledger. Material ledger and actual costing. Material ledger is nothing but a one tool. Actual costing means need to be execution. Here material ledger means here I am going to create a two controlling area, two company codes. One for multiple currencies. Second one, multiple valuations. Multiple currencies means company code currency, group currency, and hard currency. Only normally this we can familiar with one hard currency, group currency, as well as company code currency. But here instead of a hard currency, we can go and implement by way of this global company currency as well as index based currency. Normally what we observe so many times, we heard this word. One is the company code currency. Second one is the group currency. And majorly some lot of we heard so many times. One more thing is the hard currency. Hard currency means if we are listed in our manufacturing process, our company is a listed company, then we can compare with the hard currency. Any means stand means here normally standard currency, half hard currency is nothing but US. We are all comparing with the US market only. Our anything is even rupee value also we are going to compare with, not for Indian rupee, for all countries of currency they are going to compare with the hard currency of US currency only. So hard currency is nothing but a where we are going to compare with our currency, normally US market. So US is nothing but a hard currency. But not only hard currency, we can go and implement by way of index based currency, or by way of a global company currency also. That means here, not only here restrictions of a hard currency, but either hard currency or index based currency or global company currency. Either of them we can able to implement along with the company code currency and group currency. Company code currency is nothing but our company code point of view. Financial statements we are going to prepare based on this company code point of view, legal valuation. Group currency is nothing but client oriented, which is nothing but normally this we are going to implement is a controlling area creation point of view. And hard currency means our financial statement, our controlling area currency comparing with the leading top one, means top is nothing but in present situation US market is the top position. We are all comparing with the US market only, and rupee value is dollar value, whatever it may be, comparing with the dollar value. So normally hard currency is nothing but US oriented. But here not only restrictions for hard currency, we will go and implement either index based currency or global company currency. Global company currency means company currency we can go and implement here. May different, hard currency different, global company currency different, index based currency. And coming to the multiple valuations means fully concept of a transfer pricing concept here. Transfer pricing means within the company code, intercompany intercompany and intra-company. Both the concept. This is the most important point here. That means multiple valuations means legal valuation, group valuation, profit center valuation. Normally this terminology we will, but for what purpose? Don't know actually. Only legal, so many times I also heard multiple currency means company code currency, group currency, hard currency. If I don't want hard currency, what next means no one knows. But here some techniques are available. Same similarly, multiple valuation also. What is the purpose of this one means group valuation, legal valuation, as well as a profit center valuation. Profit center valuation means only here we can able to think about the transfer pricing. Then group valuation, what about the group valuation concept? That also need to be as a implement of a transfer pricing concept. What is the purpose of means based on the some business process, we will go and implement of this transfer pricing, intercompany and intra-company. How we are going to deal? Intercompany means is a transfer one material transfer one company code to another company code, deals with is a group valuation. Intra-company means within the company, material is a transfer one plant to another plant. If you want some extra charges, that is nothing but a profit center valuation. Both are need to be linked with this legal valuation to prepare a financial statements. So legal valuation, group valuation, and profit center valuation means the purpose of this one is a group valuation means elimination of a internal revenue from whether it is a material is a transfer from cross company code or within the company code. Means I don't want any surcharges or revenues from one because of both are same company within the our company only. Then that is not actually speaking of that is not actually speak as a revenue. That is we need to eliminate. How we are going to eliminate that means intra transfer pricing is nothing but by way of implementing of a group valuation. If you want reporting point of view profit center oriented, then we can go and implement profit center valuation. Both are need to be linked with our financial statement like P&L as well as a balance sheet for legal valuation. So here two setup we need to design, one for multiple currencies, one setup, and multiple valuations is the different setups. We can able to mix, but here only two currencies, not third currencies we are not going to implement. Company code currency, group valuation with transfer pricing, profit center valuation we can implement, but third currency we can't able to view if you mixing of these two. So better to go for separate multiple currencies for our testing practicing point of view. In live environment, they will go and club these two. Company code currency, group valuation, and profit center valuation. Like that is a mixing of these two. But separate means a lot of benefits are there if you are going to testing with these two scenarios. And here, work in process activation. Normally, work in process concept is a product costing. Material is a completely still in process, not a fully manufacturing. Normal domain term, not SAP. If material is a completely manufacturing, still manufacturing process, how we are going to deal with this work in process? And this one, physical inventory count. If material is a manufacturing, that material is a every 3 months once, 6 months once, and 1 year once. If it is a count, normally people they are going to miss side. They are going to count of every quarterly or half yearly how many materials are available still. How is there any difference between SAP as well as a physical inventory count? If any differences, how we are going to adjust it to the our product costing, our material ledger. That means here physical inventory count link with the material ledger. It's nothing but actual cost. Here also WIP activation, how we are going to link with the material ledger through product costing on. Means here physical inventory count of our material as well as the activity types, how we are going to deals with the material ledger is nothing but a distribution usage variance. One technique is there. This by way of this technique we can able to use distribution uses both material as well as activities. New functionality of a material ledger distribution usage variance. Long back is available, but nowadays most popular of this one distribution usage variance by way of a physical inventory count. After counting, how we are going to adjust that difference amount to the actual costing. And one more thing, nowadays a lot of companies are wanted to implement alternative valuation. What is the meaning of alternative valuation? Means normally to get the actual cost, we are going to execute the actual costing. That's it. How much of a expenses, price differences during the period and month end. If any price differences are occurred, we can go and get the actual cost. But here, this is the advancing of a actual costing. Means this is nothing but a material ledger alternative valuation run. Transaction is the CKMA CP AVR concept. Alternative AVR is nothing but a alternative valuation run. What is the purpose of this? Means if companies are following a different multiple accounting principles. For example, local accounting principles, international accounting principles, IFRS as well as a local accounting principles. Local GAAP. IFRS means International Financial Regulatory Statutory Reports, and the local GAAP generally accepted accounting principles. If they're following of a two different accounting, more than one accounting principles, one for local point of view, local government point of view. Second thing is a international point of view. If you are following of this type of a two accounting principles, one local accounting principles, we are going to implement normal material ledger actual by way of actual costing execution. And if you are following of IFRS implementation, how we are going to deals with separate by way of alternative valuation. Alternative valuation means companies are following a two accounting principles. Accounting principles means definitely the cost is going to vary from one accounting principles to another accounting principles. So if two accounting principles the companies are following, how to actual cost will get the picture. So we need to execute along with actual costing for the same material. We need to go for alternative valuation run actual costing also. Here the thing is the material ledger is the advanced version of a material ledger. Normally people will stop with the material ledger by way of actual costing, but if companies are following a more than one accounting principles, so second accounting principles, how actual costing, how we are going to get, that is nothing but a CKMLC PAVR is a transaction. This is nothing but a alternative accounting, alternative valuation runs by way of execution of a CKMLC PAVR. These are some techniques are available in actual costing. Means here each and every transaction means actual costing means revaluation of a consumption. Some techniques are there, but majorly these are techniques in the material ledger by way of actual costing execution. And margin analysis. Margin analysis nothing but account based COPA, but till 2020, this account based COPA we can able to view in operating concern. Nowadays, in a KEAG account based this operating concern, this terminology also we will not able to see. Only the SAP implemented that's a margin analysis only. No account based to COPA that statement, that word also not available in operating concern now. Operating concern is not but highest level of the organizational structure. There we will not able to see till 2020 we can able to see that is account based COPA. But here only margin analysis only we can able to view. What are the major functionalities are available in margin analysis means first major techniques, all data flow to the same how we are doing to COPA, same marginal costing, how same data will go for, but completely GL based. Means whatever the GL account is going to updated in the COPA, that means completely this is a GL account based concept. If you create a one GL account, make it is a cost element that is going to update it in the profitability analysis. Now concept of a some other any value fields. Value fields is nothing but if we are implementing of a costing based COPA earlier scenarios in ECC, most of the companies are following a costing based COPA. But now as for HANA completely that FI and CO is a reconcile easily smooth process. So no one is the interested to implement of costing based COPA. So and also in SAP also from one version to another version keep on the features are adding by way of a FDAPS techniques implementations. And here COGS split. COGS split means is nothing but here at the time of a delivery normally accounting entry will generate, but corresponding one more accounting entry will generate based on the our costing structure, cost component structure means here how COGS split is going to implement, that is a purely account based COPA only we need to maintain. Similarly, price variance split also. Price variance split also we can go and implement this one by way of this marginal costing implementation. And fourth one is the attributed profitability analysis. Attributed profitability analysis means here once you create a sale order and delivery, but no need to, normally this suppose if it is a production order point of view, normally production point of view month end only we will get the some actuals. We don't want wait till month end to until unless getting a actual costing. I want to know right now of how much of expenses means rough expenses, how much of I wanted to know. This by way of a attributed profitability analysis is the technique. Immediately once creation of anything of expenses, no need to of maintain till month end to settle all expenses. Directly you can go and check in COPA, we'll get the updated. Third one is the predictive concept. Predictive for incoming sales order. This is the nowadays for all clients they wanted to predictive concept. Means here margin analysis is nothing but a rough estimation of our cost, our revenue and our profit. What is the purpose of this one means once you create a sales order, how much of my cost, how much of my revenue, how much of my profit margin. So I wanted to know because of this month delivery will done, sale order delivery this month. Billing after 2 to 3 months only we will get. After 2 to 3 months we will get the revenue. Then only we can able to identify this our profit margin. So we should not wait till till billing point, billing rise point. I want to know once a creation of a sale order, whether it is a delivery happen, billing happen, that is a different case. I want to know how much of a profit margin immediately after creating of a sale order.